Good afternoon, ladies and gentlemen. It is May 22nd of 2022. My name is Robert Rayburn here at LifePro Asset Management, and we're certainly glad that everyone could join us today. We have a lot to talk about, the ongoing debt ceiling negotiations that are taking place in DC. And I don't usually say this, but we record these on the Friday and then we send the webinars out on Monday. So anything I say about the debt ceiling, do preface those comments with the fact that we're talking on Friday and lots can change between Friday and Monday as it relates to political negotiations. We all know that to be true. So with that said, let's go ahead and get started. The title of this week's presentation is the AI bubble. Now, over the last month, those of you who are invested with us know we have a 0% way in technology, and that's going to stay the case for the foreseeable future. Now, the reason is valuations have gotten to absolutely ridiculous levels. So when we look at the NASDAQ, when we look at the mega cap bank stocks, when we look at these so-called artificial intelligence stocks, they are trading at absolutely insane levels right now. And so we look at NVIDIA trading at 105 times earnings, or we look at the NASDAQ as a whole trading back to valuations north of the 2000 dot-com tech bubble. We made a really good decision in 2021 to sell tech at the top. We rotated into energy, we rotated into industrials. Unfortunately, we didn't have the patience to see that trade through, and technology continued to go up, and we got back in, and that's when technology ultimately sold off as per our call. And so what we want to do is make sure we're staying disciplined to our process. What does our cycle work say? It says that technology is overvalued. It's continuing that process from 2 years ago of unwinding the mega bubble in technology and growth. And we should see that money rotate into industrials, into commodities, into precious metals. And we're going to go through all of that today. So the three big things from this week, aside from that AI bubble and trying to avoid that, is the stock market continues to narrow. And we've been saying this week in, week out. I went through 08. That narrowing process, you can see the market go up and the market narrows, and you can be impatient as to when that all unfolds. But you have to be patient. Don't chase stuff that's running up right now. Number two, the mega cap tech bubble is a clear and present danger. It's one of the most overly owned asset classes out there in the stock market. Almost everyone has exposure to it. And so we want to be careful there. And then lastly, gold is catching its breath. We underperformed this past week. Why? Because we're overweight gold, we're overweight energy. We don't care in terms of that day to day. The cycle framework does say that we suggest that we're going to have a pretty persistent rotation into these areas of the market. So we want to stay disciplined. We learn from our mistakes in late 21, early 22. And of course, it's all about the US dollar. We're going to go through that today. Now, as it relates to the ongoing debt ceiling negotiations in DC, there was a big rally on Thursday, on Wednesday, as it related to stocks. And one thing we noticed was US credit default swaps didn't really notice it that much. I mean, they came in a little bit, but remember, this is where they were trading in January, way down here in terms of that risk premium, a huge explosion, and they came in just a little bit. So the bond market remains very skeptical that a deal is getting done or that a deal has been done. And so we're paying attention to this. When that gives the all clear signal, then we'll adjust our stance as well. Underneath the hood, and this is unrelated, I want to be very clear, unrelated to the debt ceiling, is that breadth in the market continues to collapse. So what does that mean? As the indexes are going up, fewer and fewer stocks are participating in the rally. That is not a sign of a persistent bull market. And we're going to go through exactly what that means. So if we look at from 1982 to 1985, this is an example of a market that bottomed and had what we call a durable rally, right? So we look here, market bottomed in August of 1982. rallied strongly. And guess what? You had 90% of stocks that were participating in that rally. But then we look at the early 90s, right? So the market rallied, but fewer and fewer stocks were trading above their 200-day moving average. And ultimately what happened is you had a stock market that caved before the final bottom was put in, and then we got a bull market that went underway. But this was a very severe correction in the market. So we want to be careful. We don't want to own things that are beta or risky as it relates to growth or technology or AI concept stocks. We want to be really careful right here. So weak breadth historically leads to failed rallies. Not a guarantee, but historically leads to failed rallies. Strong breadth historically suggests a more durable rally. And we can see what's happening underneath the surface here. So Apple and Microsoft alone, just two stocks, now represent 14% of the S&P 500. So what do you think about when you think of the S&P 500? Well, it's diversified, it's low risk. Over time, I get a broad collection of corporate America. But what's really happened over the last few years, it's become hyper concentrated in just a handful of stocks. And now we see is even after last year's bear market, Apple and Microsoft are now at all-time highs as it relates to a percentage of the S&P 500 at 14%. You add in NVIDIA, Tesla, Amazon, Netflix, and you get closer to 30%. And so the top of the market is extremely concentrated right now. And these are the stocks that are holding up the rest of the market. In fact, Apple crossed an important threshold this week. Apple alone, one company, is now worth more than the entire Russell 2000 index. We can see that here. So the black line is the Russell 2000, those 2,000 stocks on the Russell 2000, their market cap, and the red line's Apple. This week, we crossed that threshold. An absolutely incredible feat for Apple. Obviously, a very well-run company, but also a very, very expensive stock. And we always have to separate what we think about the company versus the price of the stock. And the timing's hard on this, right? You can look at Apple and say, man, I wish I owned it. Maybe we should buy it. And it's a great company. It trades at 30 times earnings for a $3 trillion stock. So we have to be really, really careful. Yes, it's a great company, but it's a very expensive company right now. And this is the best illustration that I can provide. A market that has weakening breadth is sort of like a sinkhole, right? So we see a sinkhole, and over time, there's gaps that develop underneath the surface. Those gaps start to go up the market, right? And over time, those gaps become very persistent, like we're seeing today, where really the only thing that's holding up the last few stocks, so if you consider these two trees, Apple and Microsoft, is really just this thin layer of soil, which maybe you can consider NVIDIA and Tesla and Amazon and Netflix, et cetera. And then eventually it caves in. And so for me, when I see this type of illustration, it reminds me a lot of the weakening breadth that we see in the overall market right now. So what does that mean for asset allocation? Well, first of all, as conditions do weaken, as we expect them to, as it relates to the market or just the broader economy, we do expect interest rates to start coming down, okay? And as interest rates come down, we want to ask ourselves, historically, in a weakening growth environment where recession risk increases, we're not making a recession call, we're saying recession risk increases, what are the asset classes that perform well, aside from treasury bonds? When we look here, one of the asset classes that has performed remarkably well during those time periods is gold. So we ran a regression analysis of gold versus the 10-year tips, right? So in other words, real rates. So interest rates minus inflation. And so when real rates are coming down, the price of gold historically goes up. So you can see here, this x-axis, as real rates go down, the price of gold historically has gone upward. And that's sort of what we're expecting here. Again, I don't know what happens on Monday, Tuesday, Wednesday of next week, but that's what we're expecting here over the next few months throughout the remainder of 2023. So rates down, gold up. And the bigger reason why we're very bullish on the price of gold and gold assets is the dollar cycle. And this is actually from one of the top ranked strategists on Wall Street here at Bank of America, is that the US dollar has now started to enter what they believe to be a fourth bear market. So over the last 50 years, we've had 3 bear markets. All of those have coincided with a gold bull market, and what they believe is now a fourth bear market that is beginning to unfold with the US dollar. Now, if you've been listening to our weekly updates, you'll know we've been very persistent on that call, saying that we believe that that is true. The US dollar is entering into a new long-term bear market, not dissimilar to the early 2000s or back in the 1970s. And we see that here in this chart. Again, we've recycled this chart a few times, but I think it's important. Gold, when the gold goes into a bear market, the US dollar is up. When the US dollar goes down, we get those gold bulls. Again, this was another period of US dollar strength, gold bear, and then of course, another big gold bull market. Why? Because the US dollar came down. Over the last 10 years, US dollar has been strong, bear market in gold. And again, if this is the peak, we expect that gold bull market to come into fruition. So what is that potential gold upside? So one of the things that a lot of commodity investors use, particular gold investors, is what we call the Dow to gold ratio. So this is a chart of the Dow to gold ratio over, call it the last 80 years or so. Now, if we get back to just the 6.7 ratio of Dow to gold that we saw at the prior gold peak in 2011, I believe it was, that implies a price of gold at $5,000. Now, it sounds attractive, right? But what we want to do is say, well, what if this is all coinciding with a bear market in stocks? Like, what happens if the Dow goes down 20%, right? So if the Dow goes down 20% to 26,800 and we achieve that 6.7 ratio, Dow to gold ratio, that implies a long-term target for gold of around $4,000. Again, we're not saying that's happening here over the next couple of weeks or the next few months or even the next year. We're looking at a multi-year bear market for the US dollar that should coincide, in our belief, with a multi-year bull market for the price of gold. In addition to that, we love the fundamentals, right? So when we talked about energy and oil a few years ago or 2 years ago, we noted that the energy space, and it's true to this day, suffered from a lack of capital investment in the ground, which will prevent a supply response to rising demand in the future. That turned out to be true. We're seeing the same thing play out in the gold space. So when we look at the net when we look at the net repurchase activity minus CapEx, what we see here is that the amount of net CapEx, the capital expenditures, going into the ground is declining. In other words, more money, this chart on the right here, what this is basically saying is more money is being used to purchase back stock than it is being used to put money into the ground to develop new mines. And we also see evidence of that at the mega cap level. Newmont recently completed its acquisition of Newcrest, one of the biggest gold mergers in recent memory. Why are they doing that? They're doing that because there's fewer and fewer mines to develop and bring gold out of the ground organically. So you have to go out and purchase the reserves. That's a sign, again, that the amount of organic production in new mines is not expected to it's not expected to really grow that much over the next few years. And this is happening in the backdrop of record buying activity by the central bank, as we see here with the chart on the left. So overall, ladies and gentlemen, what's the game plan here? Stock market is continuing to narrow its narrowest since the early 90s. So this is really not the time to chase another technology bubble. This is a mini bubble within a broader bubble that continues to deflate, in our opinion. And so three big things here. The rush into FANG stocks looks increasingly like a mania right now. We're talking fantastic, incredible companies that generate lots of cash flow, but the stocks are really, 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 really expensive. Number two, we think growth is slowing. And lastly, we do believe that inflation is decelerating, and those factors should lead to a rising price for gold and other commodity assets. So that's what we got for you this week. 888-543-3776 is our home office number if you have any questions. And always please reach out to your advisor if you have any questions or concerns. Thank you again and have a great week.